FinTech folks, this one is for you. Let's talk about the open banking rule, what it is, where it stands, and where we're going. I'm going to take a little longer than usual today to talk about this important piece of U.S. federal legislation. Knowing the ropes here might make a huge difference in your access to consumer financial data and therefore your profitability, so be sure to stick around. The open banking rule lives in Section 1033 of the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010, or the Dodd-Frank Act for short. The open banking rule is designed to empower consumers by granting them the right to access and share the financial data held by banks and other financial service providers. In summary, the rule requires these entities, referred to as data providers, to make at least 2 years' worth of account data, such as balances, transaction dates, amounts, and fees charged, available to consumers and authorized third parties in a usable electronic format free of charge. The rule establishes consumer data access rights, imposes obligations on both data providers and recipients, encourages the use of standardized formats, and creates a process for implementing best practices and protocols. It sets out privacy and security requirements, limits how third parties can use a customer's data, and implements consent and control mechanisms. In short, the open banking rule is aimed at supercharging a consumer's access to his or her own data in a uniform and secure manner. Perhaps most importantly, it was designed to limit gatekeeping on the part of traditional financial institutions by putting the burden of making this data available on them. The rule was drafted to take effect in phases beginning in 2026 through 2030, with the largest institutions being required to comply first. While Dodd-Frank has been around for a long time now, it is only recently that the open banking rule began to take shape. Dodd-Frank created the Consumer Financial Protection Bureau, or CFPB, which is empowered to implement the statute through rulemaking. President Biden appointed Rohit Chopra, a former FTC commissioner and strong consumer rights advocate, as the CFPB director in 2021. In October 2023, the CFPB released the proposed open banking rule, which it subsequently finalized on October 22, 2024. During this time, while Dodd-Frank was percolating, we witnessed the rise of FinTech companies like you. Plaid, a leading connector between consumers and their financial information, was founded in 2013. Financial education and personal finance software like Mint, Chime, Rocket Money, and others gave consumers new ways to track confusing, complex, and messy information spread out across multiple bank, credit card, and other accounts. As the very talented Caitlin Long of Custodia Bank put it, FinTech spent the years following Dodd-Frank building Ferrari front ends on steam engine-era traditional banking rails. The open banking rule represented the fuel to power these Ferrari engines. Consumers celebrated access to this newly available information. Banks did not. It didn't take long for the industry to fire its first shots at the open banking rule. The day the rule was finalized, a group of plaintiffs, including Fork Bank, the Kentucky Bankers Association, the Bank Policy Institute, and others, joined a lawsuit in federal court against the CFPB, alleging that the final rule is unlawful under the Administrative Procedure Act. In summary, the plaintiffs argued that the CFPB exceeded its authority in creating the rule in the first place, and among other things, that the rule's mandate that financial institutions share consumer data for free is arbitrary and capricious, or, in plain English, unlawful. Now, nothing takes place in a political vacuum, and the open banking rule is no exception. Under the guise of cutting regulation and red tape, President Trump removed Chopra from his post as CFPB director in February 2025 and temporarily appointed Scott Bessent as acting director. Bessent sharply cut back the Bureau's operations, including halting rulemaking and enforcement, so much so that the Bureau itself filed a motion to stay the proceedings in the Fork case. This was purportedly to allow the Bureau to open up a new round of accelerated rulemaking to change the final rule before it ever took effect. The whole banking industry has been closely watching the show, including the face of TradFi himself, Jamie Dimon of JP Morgan. In a letter to JP shareholders and through other public statements, Mr. Dimon has attacked the rule on two principal grounds. First, cost. Dimon complains that FinTech's use of JP's APIs to pull customer data is massively taxing its systems and sending costs through the roof in the form of hardware and personnel required to support billions of data requests. Only 13% of these requests, he claims, are initiated by customers for transactions, implying that the other 87% of the traffic is redundant or for purposes other than what was intended by the open banking rule. Second, fraud. Dimon claims that transfers associated with data aggregators are the middlemen that standardize and clean up the information received from different accounts, are 69% more likely to result in fraud than other ACH traffic. Never one to waste time, JP Morgan recently sent pricing sheets to data aggregators, informing them of upcoming data taxes on API calls. Now, in fairness, we need to ask, does Mr. Diamond have a point? It is true that JP and all other covered entities are required to foot the bill under the open banking rule for maintaining the APIs and providing the data to consumers, authorized third parties, and aggregators. This requires servers, IT personnel, and other human and technological capital. JP Morgan is a for-profit business, and they are entitled to make that profit and to watch their expenditures. That said, let's zoom out a bit. First, JP Morgan is one of, if not the wealthiest and most powerful institutions on the planet. I don't think it's a radical idea to suggest that with that amount of power comes some responsibility to the financial commons. With a cool $15 billion in net profit in Q2 2025, I would respectfully submit to Mr. Diamond that he could probably dig through the cushions and find a few bucks for servers and job-hungry network administrators. Two, it's not clear where Mr. Diamond's figures of 13% and 69%, referring to the data pulls and fraud figures I mentioned earlier, are coming from. Perhaps he is unaware of the fact that 72% of all statistics are unreliable. Second, on the topic of fraud, Jaz Shah maintains an amazing Substack resource called FinTech Under the Hood. Shah made an excellent point in his August 1st, 2025 article, linked below, that fraud risk derives more from outdated TradFi technology than from data sharing with aggregators. Neither JP Morgan or any other bank has stepped up to improve upon ACH or other TradFi rails, instead preferring to collect the rents from systems that lack real-time fraud detection and fund settlement. Blaming aggregators for that friction, as Shah puts it, is like blaming toll booths for traffic accidents. Well put. I also get a whiff of entitlement here. After all, whose data is it? Consumers open the accounts and make the transactions. Just because the banks hold and theoretically protect that data doesn't make it theirs. In fact, they profit handsomely, not only from maintenance fees, making loans against deposits, credit card interest, and the like, but also from using customers' own data to profile them and cross-sell them brokerage accounts, financial advisory services, and whatever else. A law that permits consumers to retrieve and organize the data they fed into the system in the first place without more fees? Not exactly an outrageous assault on free market capitalism. So what does this mean to you as a fintech company and future client of good attorneys at law? First, politically, legally, and practically speaking, I would hazard a guess that the open banking rule will end up becoming a bit less open. My suggestion, start looking at your data supply chain now and run the numbers relative to how much you rely on consumer account information. As mentioned, the CFPB has ditched its court case to engage in accelerated rulemaking to fix the allegedly broken rule. JP Morgan's pricing sheet, which could cost Plaid alone close to $300 million a year, may just be its opening bargaining position, but who knows? The other big financial institutions are watching closely, and I think that we can expect that they too will pile on the fee bandwagon the first chance they get. In other words, I would brace for an increase in data costs where that data is coming from an entity covered by the open banking rule. Perhaps the CFPB will come up with a nice squishy reasonableness standard for financial institutions who want to charge for API access. Perhaps they'll come up with a formula that requires you to pay based on your call volume, or maybe even a fixed fee schedule. Suffice it to say that we should be keeping a very close eye on these developments, since FinTech's future depends on them. Time will tell. So that's it for today's roundtable on the open banking rule. If you got value from this video, I would be very, very grateful if you took just a few seconds to do all the nice liking and subscribing things. Also, tell me what you think in the comments. Are banks being put out to provide consumer data for free, or are consumers entitled to access this information under the rule as it stands? I'm Ari Good, blockchain lawyer. Please contact me for further information or if I can help. Thank you.